Hello and welcome. This is Kathleen Lovito, and I will be your host for today's webinar. Our presenter today is Matt Hicks, Relationship Manager with AAFMAA Wealth Management Trust, and he'll be conducting a Q&A with AAFMAA Wealth Management Trust Chief Investment Officer, Arthur Lyons. Before we begin, just a little background on the company. This webinar series is brought to you by AAFMAA Wealth Management Trust. Our mission is to be the premier provider of financial planning, investment management, and trust services to the American Armed Forces community. AAFMAA Wealth Management Trust is a fully owned subsidiary of AAFMAA. AAFMAA has proudly served America's armed forces since 1879 with life insurance for all branches of the U.S. Armed Forces and their families. And now just a few disclaimers. This presentation is educational. It is for general information only and is not specific investment, legal, or tax advice for any of you individually. Do not rely on this presentation alone to guide your investment management decisions. Since each situation is unique, your needs for financial services will differ. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members to help them better understand the resources available to them. We have highlighted here two distinct characteristics that separate AAFMAA Wealth Management Trust from other service providers. One, our fiduciary standard, which requires us to always act in our client's best interest. And two, we exclusively serve the U.S. Armed Forces community. Now, without further ado, I'll turn it over to Matt and Art to go over the agenda.
Hello, everyone. This is Matt Hicks, Relationship Manager with AAFMAA Wealth Management Trust. And today we thought we'd do something a little bit different for our clients as well as our prospects. Given the unusual year of 2020, we thought this would be an excellent opportunity for our Chief Investment Officer, Arthur Lyons, to answer some questions that are very popular with both our prospects and our clients. Today, we're going to cover program trading and volatility, seeking opportunities in unusual times, what role international stocks play at AAFMAA Wealth Management Trust, and why do some stocks push the S&P 500 index? Our first question for Art is regarding program trading and volatility. Art, what role do you think program trading is playing in the volatility of the markets this year? The fundamentals of the markets have been strong, but we have seen huge swings for no visible reason.
Well, hello, everyone. I tell you, Matt, we've got some very interesting clients that have thrown us some very interesting questions, and I'll try to keep my comments to brief, and because I could talk all day on some of these things. Yes, without a doubt, on this first question, without a doubt, program trading is playing a large, it has a large part to play in the volatility of the market. But there are some other reasons besides program trading. And when we talk about program trading, it also goes by a lot of other names, whether it's a computerized trading strategy, algorithmic trading, not high frequency trading, but algorithmic type trading has trillions of dollars now in their investment strategies, anywhere from 2 to 4 trillion as an estimate. But there's some other factors as well that are causing the lack of liquidity, and the lack of liquidity plus this algorithmic trading is really jolting volatility. And also I've recently read some more research that shows that option equity traded, exchange traded options are causing wide swings, intraday swings in the market as well, as market makers are trying to hedge their book. But one of the things that is not seen, doesn't get a lot of press, is the fact that in 2018 there were 12 very large market makers on the New York Stock Exchange. Those are specialist firms on the stock exchange. Those the specialist firms on the New York Stock Exchange are different than market makers on some of the other exchanges, but nonetheless, these are the entities, the people that are charged with the responsibility of making a fair and orderly market, and they will commit their own capital in times of market stress to try to balance the market. In 2018, there were only 12 market makers, and I say only 12 because there used to be dozens upon dozens upon dozens, 20 years ago. Well, now there were 12. In the past 2 years, that number shrunk even more. There's only 6 going into 2020. So that means you've got a fewer and fewer firms having to commit more and more capital in order to balance the market, and there's just not enough capital. And then when you add on the fact that computerized trading strategies have grown either by a factor of 2 or a factor of 4, depending on what research you're reading, going from 1 trillion to anywhere from 2 to 4 trillion estimated. It's a huge swings in volatility, and again, it's all very deceptive because when you see that the market traded maybe 5 billion shares or 8 billion shares in a day, you think, wow, the markets were very liquid. However, the spreads between the bid and the ask in the stock index futures market, which is a derivative, in the exchange traded equity option market, which are derivatives, and in the equity markets themselves, those spreads get wider and wider in times of stress, despite the volume numbers, because of lack of liquidity and massive amounts of money moving all at the same time. I mean, just as an example, in the month of March, JP Morgan estimated that over $2 trillion was sold using computerized trading strategies. And actually that cash was sitting on the sidelines by the end of March. Obviously they sold at the worst possible time. And that's been causing some of the increase that we've had recently, as are option hedging among the big broker dealers and hedge fund players. Yeah, there are a number of factors besides strictly program trading. There is a general lack of liquidity in the market, and there are derivative hedging strategies also going on intraday that are causing this. Now, that does cause the swings intraday. Over the long term, it makes very little difference, but over the short term, it can cause a little bit of heartburn depending on your time frame and your perception. So, do you have another question for me?
Yes, I do.
Okay.
This came from one of the other relationships managers and one of their clients and a prospect. My relationship manager has explained how you seek out opportunities, especially during the pandemic. My RM has talked about growth at a reasonable price, GARP. Can you expand on this, please?
I'd love to, because actually question 1 sort of leads into question 2. When you get these massive liquidity squeezes, when you get algorithmic meltdowns, over the short run, that causes, that takes a 10% decline and makes it a 35% decline. And what happens during that time is that you have, so to speak, the baby being thrown out with the bathwater. In other words, it doesn't matter if it's a great stock or a not so great stock, it's going to go down about 30%. When the market was down 35%, Apple was down about 30%, for example. There were some stocks that were up. I grant you Netflix and Amazon were up, but for the most part, a lot of very, very high quality stocks were down 25 and 30%. And so when that's happening in the short run, it gives you a great entry point for a long-term investor. There's that old expression that Wall Street is the only place that can have a sale and nobody shows up. And that's very true, you know. And so you've got the big funds, you've got the algorithmic traders that were selling massively into that decline. And we were using that as an opportunity to actually pick up bargains and to position ourselves for what we felt inevitably was a market rise coming out of that decline. I did not know that it would only take maybe 2 months for that to happen. And so, you know, hooray for us. And that was great, but it allowed us to pick up some great long-term companies at bargain basement prices. So that's kind of how we're seeking out the opportunities. We're looking at these declines and saying, where can we upgrade our portfolio? We sold financial stocks. We bought information technology stocks, you know, or for our clients that are in mutual funds, we sold the financially based mutual funds and we bought information technology and more growth oriented mutual funds. Because again, in a 35% decline, growth stocks are going to be down 35%. Value stocks this time around were down about 45%. That's a whole nother story. I'll get into that maybe later. But it was a great opportunity for us to position ourselves, you know, 12 to 24 months out, which is where we're always looking, and pick things up on the cheap. Now, how do we do that? So we use what's called the GARP approach. That's called growth at a reasonable price. That acronym came out about 25 years ago. I haven't heard it used very often. Now, these are for our clients that hold common stock. For our other clients that have mutual funds or a dividend-focused portfolio, it's slightly different in terms of, you know, we can't be as granular, we can't be as precise as what we're doing here. But we do have a lot of clients that have common stock in their portfolio, and this is the approach that we use. And the great thing about GARP is that it combines both value and growth. You know, there's always this big discussion and then big rotations in the market between growth stocks and value stocks and which one's going to do better coming out of recession, and, you know, where do you want to be? And the great thing about GARP is that it allows you to look at a broader range of opportunities and to be a little bit more open-minded about what value is. Because when you think about it, I mean, that old expression, one man's trash is another man's treasure. I mean, that's the way value is. Value's in the eye of the beholder. But this is the way that we look at it. So let's start at the bottom left-hand side of the screen. And if somebody has a cursor and they want to roll it around there, I want to look at that forward earnings for 12 to 24 months. That's the first thing that we're looking at. We're looking at where is the growth going to be coming from over the next 1 to 2 years. What is that growth rate? But what are some of the catalysts? Is there, you know, what's their product pipeline? What is their competitive stature in their industry group? What is their management team like? Are there macro factors like interest rates or trade and tariff issues, you know, or any of that kind of thing? Is that going to be impacting what their potential growth catalysts are? So that's the first thing that we want to look at. And then if you look at the southeast corner of that slide, you know, the relative valuation, that's the other thing. And valuation is relative to itself as a stock or to its industry. The value is not relative to the market. So the stock market, let's say, is selling at 20 times earnings. I don't feel like we have to have a stock that's selling at 15 times earnings. I mean, there are some companies that will always sell at a premium to the market. The one that comes to mind right off the bat is Microsoft. You know, Microsoft is, you know, generally 25 times earnings. Sometimes it will go up to 35 times earnings. But when Microsoft is at 25 times earnings, the market's at 13 times earnings. Microsoft is always going to be at a premium. Why? Because it's Microsoft. And by that, I mean, it's because their innovation, their margins, their operating margins, their growth rate is better than the market. So it's always going to get that premium. Well, if you value it relative to the market, then you would never buy Microsoft. If you value it relative to itself or its peer group, there's times when it looks pretty cheap. So, you know, a couple of years ago, we were able to buy Microsoft at 25 times earnings. We were able to buy Apple at 13 times earnings. And by the way, I'm looking at forward price to earnings ratio. I'm not looking at trailing 12 months. You know, that's one of the things about our industry that absolutely makes me scratch my head. You know, you've always probably heard that the stock market is a forward-looking mechanism. The market always looks ahead 6 to 9 months. That's what I've always heard. And yet, what is the fundamental foundation valuation metric that is used everywhere? Trailing 12-month price to earnings ratio. In other words, it's like trying to drive your car by looking in the rearview mirror. So, you know, what happened in the past 12 months is immaterial to what we need to be looking at, and not only as a predictor of future prices, but a predictor of future valuation and a predictor of where we think that company is going to go. So we're looking at forward price to earnings ratio using earnings estimates, generally a consensus earnings estimate going forward. We also look at free cash flow, again, on a forward basis, and occasionally enterprise value is something that we're looking as well. And we're looking at it, again, versus what it has done relative to itself or to its industry over the past number of years. And that'll give us that idea of the relative valuation. So this is how it generally shakes out. So if you take the cursor and look at the far left, there's a group of stocks over there: Amazon, Netflix, Zoom, Zillow. Those are the companies that we probably aren't going to buy. Not because they're bad companies, but I just can't justify paying 100, 200, 300 times forward earnings. Even though Amazon's a great company, maybe one of the best companies on one of the best companies on the planet. You know, Netflix is great, Zoom is great. Also, there's a lot of companies out there that are priced significantly higher than what their average relative range is. And so that's why you're not going to see those companies in the portfolio. But on the far right side, you know, the opposite there, and if Kathleen, if you wouldn't mind circling that, the deep value, you know, those are companies that they look great. They look super cheap. Why doesn't anyone, you know, I'm buying a diamond in the rough. Well, you know, I hate to single out IBM, but IBM's had declining revenue every quarter for about the past 5 years. So that's why it's selling inexpensively. There's not a growth catalyst there. You know, for a while, you could say that about a lot of financial stocks. Very cheap, but it's hard to see how they're going to grow. That's starting to change a little bit now because it looks like the macro picture and the global growth picture and the loan demand picture may be improving. So we're adding to that very, very selectively. But just to buy something because it looks very, very inexpensive in and of itself is not going to work. So, you know, what we're able to do is buy an Apple, Microsoft. I've got Salesforce up there, and Salesforce is one of those that, you know, we started adding to that a couple of years ago. It was at about 30 times earnings when the market was at 20 times earnings. Salesforce at the time, I think when we added it, was at 155 a share. It's now at right around 255, 260. On any given day, it's 100 points higher. It's going up, what, 60, 70%. The PE, though, has not expanded as much as you would think because they have been growing at a very high rate. But advanced micro devices is another one of those. The trailing 12-month PE, when we bought it, was 300. That's right, 300. The forward PE, however, was only 30. And, it was also coming out with something called a 10 nano chip. They make semiconductor chips, primarily for data centers and a lot of other things. They are the #1 competitor to Intel, and Advanced Micro at $30 was a steal. Now it's selling at around $90. So, those are the kind of things that the GARP approach allows you to do. Now, the other thing that we've done here very recently in trying to take advantage of some of these things that have been occurring in the market is, we brought on Boeing. Boeing was very inexpensive back in May. We added it at around 125, 130 a share at the entry point. Oshkosh, not the kids' clothing, but all of you in the military know that Oshkosh makes the Humvee. Chubb is a big property and casualty company. We've also added, some big pharma stocks. But some people might say, well, gee, that's a deep value stock. Boeing is a deep value stock. Yeah, it is now, but we believe it's going to be a growth stock within 12 to 18 months. Same way with Oshkosh, same way with Chubb. As property and casualty companies are starting to get pricing power again in the premiums that they charge their policyholders. So it's okay to buy a value stock now, but it better turn into a growth stock in 6 to 12 months. Otherwise, it's not going to go anywhere. And so, again, that GARP approach, combining value and growth, and more specifically, relative value and forward-looking growth, is a great approach for us, and it allows us to take advantage of a lot of opportunities. So I know I talked a little bit longer on that one than maybe I should have, but it's a terrific investment philosophy. So I think we're ready finally for the next one there, Matt.
Okay. Question 3, Art. It appears that you have been underweight international stocks the past few years. Why? You and I had a conversation at about this time last year about international stocks, and it was based on some conversations that you and I had seen on the various business channels. And that conversation with you and with clients has led to this question.
Yeah, so before you advance the slide, let's take a step back. Whether you own common stock or whether you own a mutual fund comprised of U.S. companies, if you own a stock that's in the, whether it's the Fortune 500 or the S&P 500 or S&P 1500, if you've got any kind of a multinational stock, you're going to see 30, 40, 50, even 70% of the revenue of those U.S. companies being generated overseas. So you can own a U.S. company that has exposure to international markets. That is very different than owning a company that is domiciled and managed out of a foreign country. And I think the reason for that boils down to 3 things. I think there's greater regulation, greater taxation, and less innovation. But also, I'm going to throw labor and employment issues into the mix as well. And I'm thinking, first of all, about developed Europe, but you could say that with a lot of other areas around the world as well, that, when you want to develop a COVID vaccine, it's going to be Pfizer and Moderna that get there first. It's going to be Johnson and Johnson. It's going to be, great. I'll give you AstraZeneca, which is overseas, but I'll raise you 3 or 4 other companies that are over here. Big Pharma in the U.S. is the greatest thing in the world. Anybody that's on pain medication, anybody that wants a cure for cancer, you come to the United States and you get that done. The internet, social media, for all of its good or bad parts, whatever, you got to say that it transformed the world. The iPhone was invented in the United States of America. Parts made in China, I'll give you that. That's going to change because there's a new technology that will transform industrial production that's coming here out of the United States. It's going to be public here in about a month. So if you want to look for all that innovation, you got to be in the U.S. Now, how does that play out? Now you can advance the slide, Matt. I'd appreciate it. And I'll show you what we're talking about. So if you look at the last 20 years, by the way, 30 years ago, international investing started to get, before I talk about the chart, 30 years ago, international investing was like the darling of institutional investors. Why? Because it didn't move the same way that US stocks moved. There was what we call about a 35% correlation with the United States. So when the US market zigged, the international market zagged, and that's kind of what you wanted in a diversified portfolio. So 30 years ago, the correlation to the developed international world was 35%. Today, it is 86%. And it has been at the 85% or more level now for about the last 10 years. Well, if that's the case, then why not just buy the US? It makes no sense. Let's take a look at this chart. And Kathleen, with that cursor, if you don't mind, there's a blue dot up there on the chart that says 3 assets. And this is a risk return chart. The vertical axis shows the average return of the assets. The horizontal axis shows the risk level. So that's the risk and return plot for 3 assets. Now, if you'll move it to the right slightly, and you see we're 4 assets. If you add in international stocks to a portfolio, you have not gained any additional return. But guess what? You've added 50% more volatility to your portfolio. Can you believe that? 50% more volatility and none of the upside. That's why we're underweight on international. And then you can do the same thing a little bit higher up on the chart where you see 6 assets, and then number 7 assets. That's when you add in emerging markets. Now, slightly more return, 15% more risk by adding that asset on there. So, I mean, whether it's numerically or whether you're analyzing just the structure of overseas markets, in the aggregate, it does not add value. Now, that's not to say that in any given year, you could get an individual country that gets very hot. I remember one year Singapore was up 128%. Hey, great. If we had a Singapore ETF in the portfolio and we happen to pick it on the right year, then great, we're up 128%. And while there are good individual companies, Nestle's comes to mind, GlaxoSmithKline comes to mind, some of the Swiss, some of the German companies, very, very good. There's, Toyota's the biggest car manufacturer in the world. I grant you that. But in the aggregate, when we're adding international to mutual fund portfolios, we want to be underweight. If we're looking at a common stock portfolio, I'd rather do some very strong analysis on US companies. So we still have international exposure. So we do have to pay attention on what's going on in the rest of the world. But in the aggregate, it doesn't seem to add value. And with that, I think we can move on to question 4.
Thank you, Art. That was very, very enlightening in terms of how we look at international. This is a question that has come up a number of times. Do some stocks push the S&P 500 index? How do you measure success when only a handful of technology stocks seem to move the S&P 500 index, Art?
Well, I tell you, I always enjoy getting questions about index construction because it is absolutely fascinating. Because most indexes are market capitalization weighted. So the greater the value of the company, the more it's going to impact the index. There is one index. Well, then they started to construct equally weighted indexes where every stock has the same, regardless of capitalization, has the same weight. We'll talk about that in a minute. However, if you look at the S&P index, if you look at the S&P equal weighted index, going back 30 years, which is as far back as I can take that equally weighted index, there's only 0.6% difference between the equal weighted index and the market cap weighted index of the S&P, which is amazing. So some years like this year, there's going to be a great disparity, but other years, the disparity will go in another direction. But over time, it doesn't really matter. Then let's take a look at the S&P 500 and the Dow, which is a price weighted index over the last 50 years. And there's virtually no difference, which I found absolutely amazing. So yeah, you advance the slide here. This year there is a big disparity between the market cap weighted stocks, the 10 stocks at the top, and we all know the names, right? Facebook, Amazon, Microsoft, Google, Netflix, Home Depot's going to be up there, Walmart's going to be up there, versus an equally weighted index, huge disparity. Same way with the Russell 2000 on the small cap stocks. So this year, mega cap stocks are greatly distorting the measurement, but over a much longer period of time, there is no distortion, which if you think about it, I think statistically is amazing, because it doesn't matter if it's price weighted, market cap weighted, or equally weighted over 20 years, 30 years, 50 years, it all evens out. But if you wouldn't mind, well, let's look at the next slide as well. And we also want to talk to that. And if Kathleen, if you could circle that right about in the middle, that there's a red triangle that says large cap. That seems to be the optimal place to be, at least over the last 20 years. But I think, going forward, I think that's going to continue to be an optimal place versus if you look at more to the right, there's small cap dot, there's a mid cap dot, you'll see the emerging dots out there. What that's telling you is you got to take on a lot more risk and you're not getting paid nearly enough to own those. The best risk adjusted return belongs to the large cap area. And so, our job is to try to find mid cap stocks that will do so well that they will become large cap stocks. We need to find large cap stocks that will eventually become mega cap stocks. And so that's on us. But the risk return clearly favors large cap and more specifically large cap growth. Companies that are growing their earnings, have visibility and good operating margins are those kind of stocks that will continue to be in demand. And yeah, that does seem to be a handful. But at the same time, there are a lot of other companies that maybe are under the radar that are equally as good. So we do have to measure ourselves against something. To get back to the question, we do have to measure ourselves against something. And from one year to the next, it might seem, well, the S&P 500 doesn't seem to be the right measurement, or maybe it's more like the Dow, or maybe it's more like this one, that one. There's thousands of indices out there. But the S&P is a standard index, and over a long period of time, it's probably going to be as reflective as any as a measurement of, quote, the stock market. I mean, if you think about it, it always manages to keep up with the times. 20 years ago, well, today, the most valuable company in America, well, in the world, is Apple, right? We all know that. 20 years ago, well, 10 years ago, the most valuable company in America was ExxonMobil. You ever heard of that one? Remember that stock? 20 years ago, it was just crossing over to ExxonMobil, but it had been General Electric. And then when I started in this industry 40 years ago, most valuable company in America was General Motors. So you can see how, as the years have gone by, just the kind of the natural order of the market, industry, innovation, and the flow of capital, the market, the index will kind of manage to keep up with the times. So we've transformed from an industrial / energy driven to a technology / information driven economy. And the index reflects that. And so it's up to us as money managers to have our portfolios keep up with that, and to keep up with that transformation, and to look for the next best thing that's out there. Yeah, it's been a very interesting year. And in fact, next month, in January, I'll be doing my year-end review, but also my market outlook for 2021. And we'll be talking a bit more about that and what we see in the next 12 to 24 months out there. But Matt, I have thoroughly enjoyed fielding these questions from our clients. I love our clients because they are very well educated, very thoughtful. Many of them have very interesting careers, or have had interesting experiences in their career. And so it's always a joy and a challenge to field these kind of questions. So I really have enjoyed the time here. Thank you.
Thank you very much, Art. Everybody really appreciates it. This has been very, very enlightening and great simplified explanations. As you always teach the relationship managers, try to avoid and ignore the noise. And I think you've answered these questions very, very directly. I know that my clients and prospects will appreciate all the answers that you've given. If anyone has any further questions, my contact information is available here. On behalf of myself, Art, and the rest of AAFMAA Wealth Management Trust, we wish all of you very safe and happy holidays. And thanks very much for listening to us today.